Welcome to The Exchange, live from the floor of the New York Stock Exchange. I'm Douglas Jonas, your host. As a reminder, today's episode is for informational purposes only. The NYSE does not recommend investments or investment strategies. I'm joined today by Bill Davis. Now, he's Managing Director at Stance Capital. Bill, thanks for being here.
Thanks for having me, Doug.
I want to get right into it. Why did Stance Capital launch an actively managed ETF?
So the short answer is investors were asking for it. I think that the more in-depth answer is that the ETF, first of all, we're an active manager and we trade a lot. The ETF brings, I think, significant tax advantages to taxable clients of ours. Secondly, we wanted to democratize the idea of good ESG and making it available to investors of all shapes or sizes. And previously, we have been managing a SMA version of the same strategy with a 7.5-year track record. And within an ETF, obviously, people can buy it in smaller increments. So it just made a lot of sense.
Now, the ticker symbol STNC. Tell us, how is STNC different from other ESG ETFs?
Sure. So I'd say in a couple regards. The first is that most ESG strategies are growth-oriented and actually are kind of a proxy for mega-cap tech and comm services portfolios. And while there's nothing wrong with that, our view is that many ESG investors are actually interested in climate risk. And ultimately, you're not solving the problems of climate risk by only investing in companies that don't have a carbon problem to begin with. So a key point of difference with STNC is that it is a large cap core ESG strategy, and therefore we're actually investing across as many segments of the economy as possible.
Now, you mentioned the idea of risk, and I know in the past we've had conversations, you've brought up the idea that risk management really can be a part of portfolio construction. Could you go into that a little bit for us?
Yeah, so I would say STNC, first of all, is an actively managed, systematic strategy, and risk management or risk efficiency is fully 1/3 of portfolio construction. And we believe that it's an important source of outperformance for us. It allows us to not so much predict the future returns of individual positions within the portfolio, but rather predict the future relationships between positions in the portfolio. And therefore, from our standpoint, managing risk is managing financial risk. This allows us to do that. And it's also, by the way, I think looking to risk efficiency as a means of generating outperformance is actually easier than trying to pick stocks and find winners. This allows us to ideally achieve the upside of the benchmark while avoiding some of the downside of the benchmark as a result of managing tail risk.
Yeah, now you're talking about alpha, this outperformance. I know in the past you have said to me that ESG need not be a contributor to alpha. What is it you mean by that?
Yeah, so we actually think that it's good if ESG and alpha are decoupled. And I say that because, well, number one, I mentioned that we're systematic, we're unemotional, we're quantitative, and we're active. So we're actually rebalancing the portfolio every quarter, right? So we're not in a name necessarily long enough to fall in love with that name. And I'm not saying that there aren't ESG strategies out there that can't hold a position for a long time and achieve some alpha from it. However, we think that that every part of portfolio construction's got its own assignment. And for us, the job of ESG is to achieve values alignment for the clients. The job of machine learning fundamentals and risk efficiency is to generate outperformance within the strategy. And I would also say, Doug, that as time goes on, ESG is sort of training wheels around values alignment for a lot of investors. And as they get more into it, they're actually going to get more thematically specific. So what's today an ESG strategy for an investor tomorrow might be something built around human rights, or it might be around gender investing or sustainable agriculture. By separating the alpha from the ESG, it gives us the confidence that we can build other types of portfolios and launch other ETFs that are specific to those specific thematic preferences and do so without undermining performance.
Well, that's Bill Davis, Stance Capital. STNC is the ticker symbol of the ETF. As a reminder, you can find this episode along with a number of other educational episodes at our website, homeofetfs.com. That's a wrap from the corner of Wall and Broad Streets, the New York Stock Exchange, the home of ETFs.